All right, 1 2 1 2 1 2. Hello everyone. How is everybody doing? If you can hear me loud and clear, please give me a thumbs up. Another closing bell show, another live show. Really excited to have everyone. We have a really special guest as well. Andrew, how you doing?
I'm doing well. Thank you so much everyone for coming. All of your 72, 69 people. Today was actually a very, very surprising day for me. I don't know, Adi, you're going to touch on that. The news came out that Elon Musk is actually having a twin. He had, sex with one of the top executives at the SpaceX, and they have a twin together.
Oh, wow.
And then as soon as the news broke out, Elon Musk said that I did that for the humanity because we are underpopulated.
Yeah.
So that was really funny.
that was hilarious. Is that why Tesla's up about 6% today?
The whole market is rallying. Adi, SPY is 1.6%. IWM is leading the charge by 2.4% and Q is 2.2%. So small caps were really, really beaten up. They're bouncing back. SPY is bouncing back to some very, very important resistance level.
Yeah.
I don't know exactly why the market is rallying.
Yeah.
It might be just a short covering.
Yeah, this could be a bear market rally. I got yesterday I talked about that Tesla trade, that condor that I have on Tesla, and the top part is not having a good time, man. I keep buying Tesla just so I can hedge my delta, and Tesla keeps going higher and higher. So, this is a little bit of a trade management that I have to do actively, and it's been a little challenging. But, what's market without some challenge, right? It's definitely a tough market. We've talked about it. How was the webinar last night with Dr. Reed?
Because he's great.
Yeah.
I got a couple of really good emails that they thank him for the time that he has spent. He talked about the 10 things that you should do and you should not do in a bear market. And as I mentioned, this is his fourth bear market that he's having, and a lot of experience, definitely more than me and you in the market, and it was amazing. It's just he's the best.
Yeah, definitely. 100%, definitely more than me for sure. I'm pretty young, so. But last time we had Dr. Reed on the show, the best thing he told me that really stick with me is like, stop trying to make sense of the bear market rallies and stop trying to sense of the bear market. Like, things don't make sense. Like, markets is up today, and we try to, like, we talked about QQQ and say, hey, this is kind of the narrative of inflation has peaked, so growth is kind of rallying a little harder. But we're just trying to make sense of the market. It's tough, right? We think that's the reason, but who knows, really, right?
I mean, that's the thing, Adi, that you mentioned, that the price is leading and the sentiment is always behind.
Yeah, got
People
it.
are always trying to look at the past and say, oh, the rally is because of that and that and that. But when the market is rallying, it's just the price is the leading indicator of what's happening in the market. So there was absolutely no fundamental news that I saw, at least based on my knowledge, that shows that the bear market is over and we're going to continue. If anything, Fed's still reiterating the fact that controlling inflation is the highest priority, even over growth.
Yeah.
So the economy can go into a recession or a stagnation to control the inflation. So the message was very clear, but still the market today, and at least in the last couple of days, they like that.
Yeah, exactly. Stu, all of us who are joining right now, we have about 100 people joining the show. Give us a thumbs up. We have a special guest today, Singh, who used to work at Goldman Sachs. He was at their proprietary trading desk. He was doing something called merger arbitrage that I've talked in the chat room a lot. He's going to talk about his experience. Now he runs a research company where he mostly focuses on SPAC. So some really interesting conversations about the market, about how as a retail traders we can really define our edge. Is there hope for us? If not, things in that nature. It's going to be an awesome conversation. He'll be joining us in about 20 minutes, so really excited. We got tons of stuff to talk about today before the show starts, however, so let's go ahead into the slides. By the way, we've received a ton of feedback and comments on people kind of asking us to put this slide deck somewhere so people can download them. And we are actually working to have this inside the trading terminal. So what we want to do is inside the trading terminal, we want to have an area where you could every day go and download these slides for free. As long as you're signed in. So that's something we're working on. Our developers are working on that. So again, as you ask us things, we're going to make them happen. So thank you for being with the show and making this show what it is today. Let's kind of start with the market. Speaking of the market, some really interesting facts I saw over over the week that I want to share with you, Andrew. So let me go ahead and start sharing my screen. Right. So this was really interesting, Andrew. This is basically based on a research from Goldman that shows what percentage of the return in the market is coming from each section. So for example, in 2017, you can see this green part. This part of the return is coming from earnings. This is the risk premium, and then that gray line is kind of the dividend. And that year, market finished 22%. In 2018, the earning was really strong, but because the Fed was raising a lot of rates, this blue area here was kind of leading into market finishing down 4%. When you look at year to date, market being down about 17%, maybe a little less right now, you can see earnings is still up, right? Earning is still on a quarter per quarter basis, earnings is still up. So a majority of downfall that we've seen in the market is because of the risk-free rate. So we know risk-free rate and the PEs have a reverse relationship. So as risk-free rates goes up, the PE multiple has to come down, right? So that's kind of the math behind it. And I've talked about this as well. So if you got your price, which is your dividends over earning divided by R, dividend divided by R. If you add earnings, so this would be PE, this would be DE. This is where the risk-free rate comes in, right, and plays a really important role. So this was a really interesting stat that I saw, that a lot of people are saying, hey, the downfall that we've seen so far, we haven't yet priced in a recession, which means earning reduction. So this is one of the questions I have for Jay as well, but kind of interesting. So if that's true, we might see another leg down if the earnings are actually coming down. So that would be interesting as well.
Yeah, I think Dr. Michael Berry, the famous short seller of the housing market, actually said that. That's exactly what you said, Adi, that this drop is just a correction because the risk-free rate has gone up, therefore the risk appetite of the investors has come down, because now they have an option like 3-4%, 5% risk-free they get. Why would they invest into the companies?
Yeah.
And now if the companies are missing their earnings, and then that's another downward. But the question is, Adi, how bad equity market can get when the risk-free is 5%? If the companies don't provide you, which they're the more riskier assets, the equity market, the companies, if they don't provide you better return, then why would people put their money into the stock market?
Yeah, that's definitely right. So that's one of the key things, and one of the things that people look at is, and like, Warren Buffett's favorite metric when he's looking at companies is return on invested capital. So it's basically how much, if a company spends and invests in itself, like for example, like we're doing with Trading Terminal, how much return are we getting, and can he get more? Is that return more than the risk-free rate? That's one of the key things that Warren Buffett looks at. And as the risk-free rate comes higher and higher, return on invested capital on a lot of companies are going to fall down. So, for example, a company like Peloton invests in their cash flow into growth, and the return they're getting out of that investment is negative. So why would any wise investor basically lend them money, right? Buying their stock is basically lending them money and get a negative return. So that's one of the things the capital market is. As the rates go up, it's one of the dangers in the capital market, right?
Yeah, there's a famous quote: when the rates are going up, the life is getting pretty fucking fast, really quick. Yeah, so it gets really fair. So that was a sorry for the F word, but that was a quote from the movie
Margin Call.
Margin Call.
Yes,
Yeah. When the rates go up, now all of a sudden everything, all the fundamentals matters. The evaluation matters, and all the F words really here matters, and that's a very good point.
That's one of my I don't know if our audience have seen the Margin Call, the movie. That's one of my favorite scenes in the movie, in the Margin Call, where the banker is saying, "Don't think that what we're doing is wrong. We got our hand on the balance, and we're making everything balance. If the rates go up or we move our hand, then things get fair really quickly, and people don't like that."
That's really true. People are buying cars that they cannot afford, buying houses that they cannot afford, and that's all because of all the cheap money. But here's a very interesting thing: the U.S. economy is seeing this inflation, and they need to increase the interest rate. Japan is the other way around. They had all of those supply chain issues and all of those, COVID disruptions, but they continue to keep the rate down. and they're insisting on keeping their rates down because it's just a different demographic. The people are getting older and they're not expanding as much as they want. And that's why Elon Musk is saying that underpopulation is one of the very dangerous national crisis that can get to United States and most of the Western countries. China, I know that they're standing on their financial easing, and they decided to have more stimulant packages for the country, so that boosted the Chinese and Asian market a little bit.
We're going to talk about that during today's show, definitely as well. So one of the things that I wanted to talk about is put to call ratios, Andrew, on S&P 500. So if you can again go to my screen, so you can see prior to going into the sell-off that we saw in January, the market was overall, let me actually go ahead in here in January 22, right around here. The market was pretty well hedged. So you can see the put to call ratios was at around 2. So markets, people were buying more protection, more put than call. Right now, currently, we're at about 1.5. So you can see we're still elevated. I've talked about the normal put to call ratio usually is somewhere around 1.2 to 1. So we're still elevated in terms of sentiment. So we're still a little bit bearish, but it's definitely coming down. So it's either people are covering their puts or they believe they're pretty protected. Anything lower than that. Another really interesting stat I saw over the weekend. This is one of the things that Dr. Reed mentioned as well. You got your implied volatility minus realized volatility, and you can see that it's pretty negative. And this was one of the things that Dr. Reed said as well, is this market is one of those markets that's really slowly grinding lower and lower and lower. And while we haven't seen that massive VIX spike that everyone's waiting for, which will signal capitulation, we haven't seen that. The reality of the matter is realized volatility has been more than implied volatility. So the sell-off hasn't been properly priced, at least at the option market. So that's another thing that makes it such a difficult, such a challenging market. I see Grav is in the chat, and he's saying ROIC. That's exactly right. Yeah, glad to have you in the show. Thanks for tuning in. It's going to be an awesome show. But yeah, that was one of the things on sentiment. The CEO Confidence Index, this is from Morgan Stanley's research from this week. As you can see again, the lowest it has been. So usually they say this index is another one of those index that is a leading indicator. So when CEOs lose their confidence because they're foreseeing that their sales is going to drop, and then when the sales drop, that impacts earnings, and then when the earnings drop, that impacts the market. So again, looking at these sentiment and then trying to make sense of it is pretty challenging, but still pretty bearish despite the rally we've seen. New orders on ISM, another leading indicator, and now below 50, so at 49.2. So this was another interesting stat that came in as well, Andrew, at 49. So if we know anything below 50, it implies contraction, right? Kind of a recession. So this was from July numbers.
So I see that this is the worst since after the pandemic recovery, yes?
Yeah.
It goes back down all the way to the summer 2020. Wow.
Yeah, definitely. So right around then. We have about 145 people joining the show. Thank you for tuning in. Again, today we're going to have Jay Singh, who was at a proprietary trading desk at Goldman. He worked, and now he's running his own research company. It's going to be an amazing conversation. If you follow him on Twitter, he's wicked smart. The stuff he talks about, it's going to be a great show. He'll be joining us in the next 10 minutes, hopefully.
Awesome. Thank you so much, guys. And again, we are almost getting to the close. 10 minutes. Market closed very, very strong. IWM is just small cap indexes 2.3%, SPY 1.5%, and Q's 2.1%. The Apple is leading the charge with 2.4%. Apple is coming out of their territory really, really fast. And so the market, if you look at the SPY right now, is really coming above these two moving averages, 9 and 20. And but the question is if you can hold above this moving average and start moving up. So right now what we are seeing here, we already a few times we tried to come above this moving average and start a trend up, but every time it really collapsed below and then continue the move down. So the question is if you can break above and move toward the 400, or as Adi said, if the earnings start disappointing and then we're going to continue going down. I think that's $1 billion question, or maybe $1 trillion question. Nobody knows exactly what is going to happen. And it all goes into the earnings that they're coming. The Q2 earnings, I think this start, if you go to trading terminal and to the calendar, we're going to see that the earnings started pretty much next weekend. I mean, it's a very light week this week, and then we started having airlines are coming. I see Delta Airline is coming, and JP Morgan Chase, Morgan Stanley. The banks usually are the companies that start earning, and it's very important how the banks, Wells Fargo, Citi, are having, and it would be a very interesting time to see how the companies are doing, and especially the guidance that they're having.
Yeah, the banks are really important because, like we've talked about, is two things in the bank's earning. Is one of them is loan generation, is how much loan are they generating, because the more, remember, for the bank, the loans are the assets, right? It's not liability, the loans are the asset because they make money off the loan. So one of the key things you want to look at in a bank earning is loan generation. Has the loan generation in a quarter over quarter basis, has it increased? That means the economy is still strong, people are asking for loans. And then the second thing is loan loss reserve ratio. So loan loss reserve ratio in a bank means how much a bank think people are not going to pay off their loans, and they have to put it in a reserve account and kind of deduct it from their earnings because they believe in the future this money is going to be a bad debt expense, right? It's not going to be paid back. So two things you want to look at in a bank's earning is loan generation and loan loss reserve ratio. How is that moving? That gives you a lot. And of course you want to listen to the CEOs, right? Jamie Dimon will probably have something to say about the economy. He talked about the storm is coming, and I don't know again what his motives are, but he was pretty bearish on the economy. We got about 10 minutes to go. Yes, the earnings is coming up. One of the things I wanted to ask you, Andrew, is the yield curve. Yield curve kind of being inverted. What are your thoughts? What are your thoughts over there? What do you think?
Adi, yield curve is your thing, macroeconomics. I know this is so. I always try to understand this, and Adi always trying to explain me really well. So you have two type of treasuries: the short term and the long term. Short term is like 2 years, and the long term like 10 years.
Yeah.
And when you're putting your money for a 10-year, you're expecting a better return because you're committing your money, your capital for 10 years.
Yeah.
And for 2 years, you're expecting less. And this is just very typical, a lot of people who are in this market.
Yeah, they call it duration risk, basically.
Duration.
So the longer you go, you have more duration, so a duration risk. So you got to get compensated
You're expecting
more.
A better return.
Yeah.
But when this change, it means that the market is thinking differently. It means that they're paying you better for a 2-year than for a 10-year. And that means a change in the interest rates?
Yeah, so that basically means, the way I try to explain it is, when you look at the yield curve, that basically is telling you what the Fed's fund rate is going to be X amount of time. So if you're looking at a 5-year, and a 5-year is 3%, that means in 5 years, the Fed's funds rate is going to be 3%. So if you're looking at a 10-year, and now a 10-year is at 2.9, all this means is that in 10 years, Fed's fund rate is going to be 2.9. But in 2 years, the Fed's fund rate is going to be 3%. So that means in the future, the Fed has to cut rates. Now, it can be two reasons. One of them is deflationary bust. So, like there's going to be a massive deflation, but the other reason could be recession. So that's one of the things. A lot of people are saying, hey, this yield inversion is mostly because of a deflationary bust, because of all the inventories and stuff like that.
Yeah, it's possible. And it's very unlikely that the Feds can continue such an aggressive,
without
rate
breaking
hike,
something.
without really breaking something. And that was one of the things that, it was very interesting to me, like 2 weeks ago when they were talking with Jay Powell was in the Senate Banking Committee, and they were talking, and even the most liberal and most left politicians were concerned about being too aggressive and hitting the economy really down.
Yeah, yeah, and I mean, I think is like the rise in rates is definitely bad for people who have assets and all that stuff. But most importantly, it hurts middle class, right? And people at the lower end of the spectrum when things get really expensive or their borrowing cost is getting really expensive because they're usually more in debt. That's the unfortunate part. We have over 172 people. In about 7 minutes, we're gonna have Jay Singh joining the show. He's traveling, so. He's been nice enough to agree to come on the show. Speaking of the rates and rates going up, Andrew, I sent you a DM the other day. GIC, Canadian Insured Government
So
funds,
5%
yeah,
now, yeah,
5% for 5 years.
Yeah.
I mean, that got to be tempting, right? So when you're thinking about, investing your money, that has to be a little tempting.
I know, 5%, but you have to lock your money for 5%.
Yeah.
That's one thing in there, and you don't know what the market is going to go in the 5 years. I mean, hopefully that the market is not going to going down for the next 5 years. It all goes into the balance and diversification. A typical portfolio, they say, is 60-40, 60% the equity market and 40% bond market. And the bond market, because they're more stable and they're generating cash flow for a lot of portfolios that they need. And it comes to the risk appetite of the person too as well. I mean, you and I are younger and definitely have a bigger risk appetite. But
Yeah.
people who are closer to the retirement and they have family obligations, they definitely have less and less risk appetite, because if you get into the wipeouts or correction like what we are seeing right now, then the recovery might be significantly harder for the people who are. That's why trading and investing is such a personalized thing, and everyone has to make the decision about their own personal situation, because no other two people, financial, life path, family, and everything is actually the same.
Yeah, definitely. That's exactly right. And how we talked about last week, we talked about that bond, that leverage bond. And I was reading the comments, and somebody commented, "Oh, Andrew, it's very irresponsible of you. You didn't do any due diligence, and you went and bought $100,000 worth of leverage bond." Well, a couple of things is, number one is we did a whole show on our thesis, so we did do a lot of due diligence, right, on inflation and all of that stuff, and the trade worked out, obviously. And number two is, 100,000 for Andrew's portfolio is not a huge position.
It's a fraction of.
Yeah.
It's a fraction. It's a risk that I could take. It was only $100,000. I didn't put $10 million on that.
Yeah.
On a leverage product, and it was a fraction of my portfolio. So, and even if the trade went bad, I could still manage to recover from that. And that's why it's so very, very important for people not to just follow someone. I just got an email today that, hey, are you guys calling out trade and add the option trade? Are you cutting out in real time? Well, I said, well, sometimes we do, but that's not the whole point. The whole point is you join a community and learn from the resources. It's not an alert service. You might eventually become lucky to get something like the person who was following our TMF trade,
Yeah.
the leverage bonds. You might have been lucky.
Yeah.
Can you get that consistency?
Yeah.
That's the whole point.
Yeah, definitely. And like if you're in a chat room, I share my screen. You have my trade log. You see Andrew's account, right? Like everything, and we try to be like that concept of skin in the game and doing the trades ourselves. But at the same time, it's challenging, right? It's you don't want to follow people. We all have different account sizes, different age. Like my retirement, Andrew, is 90-10, so 10% bonds. 90% stocks, because I'm young. I don't care.
Yeah, I mean, we definitely can stay in the drawdowns. And I'm as well. I'm older than you, but I can still have a good, career ahead of me. And drawdowns, it hurts, but it really doesn't knock me down. If my life situation changes, imagine, God forbid, you get, for example, health problems that you need to chill and you need to retire early, and that changes everything.
Yeah, we are at 185. Hopefully we can make it to 200 people soon, right before Jay joins us. Last thing I wanted to talk about before market close and before we get Jay is that 220 billion China stimulus package. So, we're talking about China is really having problem with growth, and we've talked about the GDP for US, the average GDP growth for US is somewhere around 2 to 3% on a good year. I mean, last year of course was an anomaly. The economy grew at 6%, but somewhere around 2 to 3%. But as a developing nation, China has to grow at 6.5, 7%. So it has to grow much faster if it want to kind of maintain its population and kind of the trade surplus that it has with the world and continue with doing that. So they're having a rough year. Again, you don't know how much you can trust Chinese number, but they're having, in terms of the GDP growth, they're having a really tough year. And in terms of their monetary policy, they've been super supportive. So extremely supportive. Another 220 billion. I think it's mostly like government bonds for their municipalities, for their internals to kind of stimulate the growth. And Asian market, as you mentioned, rallied based on the news.
Yeah, 100%. Yeah, that's good. I think they're a little bit late to the game. Chinese authority, they really waited until the stock markets and in the Asia got really beaten up. I think at one point the whole Shanghai index for the tech, which is very close to QQQ, was down even in one day almost 10%. So
how's Baba doing right now?
Baba, look, I think they were doing a strong, in the last couple of days. Baba really bottomed at around early May, even though the SPY was making new low and QQQ was making new low. But Baba, the Chinese company, because again, the government has started protecting the Chinese company a little bit. They started bottoming early and they're running up at 125 right now, which is very nice. They're back into the price range that they were trading back in November.
Yeah, and I think Jay's on the line with us. Ladies and gentlemen, Jay, how are you? Welcome to the show. Thank you so much for coming.
Yeah, absolutely. Well, thanks for having me. It's been, a very interesting week. I think the market just closed, but we had two Fed speakers today, and I think, the fact that the economy slowed down so precipitously since last year has caught people by surprise.
Yeah.
And we've been talking about how the market has been overheated, but the correction we've been waiting for since November of last year has finally happened. So, we're at an inflection point, and I think everyone wants to know where we're going from here.
Yeah, definitely. Definitely a lot to talk about. And thank you so much. We had a little bit of tech issues before, but I'm so glad we have you on the line, and it's all good. So before kind of getting into your background, since you started with the Fed's meeting, let me start with this question, Jay. And of course, my partner Andrew is here with me as well. Let's talk about recession a little bit. And we just before the show, we were talking about when you look at earnings, the earning estimate for S&P is still at 220. So like I was checking this morning, still at 220. And we're down, like 16-17%. If the earning estimate comes down, let's say average earning estimate in a recessionary environment is about 15% down, if we're somewhere at like 190, what's going to happen to SPY? Do you think that's fully priced in, or no, the worst is yet to come?
So that's a great question. So, the earnings estimates across the sell side have been very bullish, and it's been a dichotomy where the two parts of, sell side, so sell side is research at, the large investment banks. And the macro group, the economists, have been more and more bearish on the economy, right? They've looked at real-time indicators, they've looked at consumer sentiment at a 40-year low, they've looked at Atlanta Fed GDP now saying we might see negative 2% GDP for the second quarter after seeing negative 1.4% for the first quarter. We're seeing decelerating metrics with ISM manufacturing data and PMIs. But on the flip side, earnings estimates for banks like Morgan Stanley are still up 15% year over year, while the economy is slowing down. So that doesn't really make sense, and the reason why is, bank sell-side analysts they build these bottoms-up earnings estimates by calling management and asking them what their forecasts are, right? It's very like a naive type of analysis where it's more of a lagging indicator, and what I've seen in the last 25 years is that even if companies miss one quarter, these analysts just keep the same estimates and they increase the growth expectations for the second quarter. So in like 2016 and 15 and 16, that the Chinese economic slowdown, the commodity slowdown, there are metals and mining companies that had guided down for 1 or 2 quarters. In the back half of the year, they're supposed to do triple the earnings. It doesn't make any logical sense. So I do think that, if you do the quick math, the S&P 500, is close to, 3,900 after today's snapback rally, and you divide that by 220, 225, we're at almost 17.7, let's say 18 times earnings.
Yeah.
But if earnings were to fall right by 10%, that would imply that the multiple is really 19.5. And given where interest rates are today, 19.5, 20 times earnings isn't really that cheap. And I know that it's a very high level way to look at it. But I do think that, with the rate move has resulted in a multiple compression across equities. But I think the earnings recession has not been fully priced in yet, and neither has quantitative tightening.
Yeah, which is, by the way, I think one of the Fed speakers was saying the QT is fully priced in today. I don't know if you saw that. I think you tweeted about it, actually. Yeah.
I was very surprised by that. And, Waller is was very hawkish overall.
Yeah.
And Bullard was actually a little bit more dovish than usual, but was also hawkish. Both are calling for 75 basis point hikes in July. And Waller actually said, 50 basis points for September. I think the economy is strong. I think the employment market is overheated. But I think both Powell and Waller have been saying QT is priced in, and it's not really based on any data, right? I think they can't afford to say anything else. And quantitative tightening in 2018, if you remember, we had several rate hikes the first time around, and it was really after 500 billion in quantitative tightening that we saw names like Nasdaq down 35%, and the spread to worse on the high yield index gap out to 500. Now we're over 600 today. That doesn't mean that if QT really accelerates, we can't go to 700, 800, and the bond markets can't shut down if the Fed continues at this pace. Right now, there isn't a big liquidity problem because the Fed is actually still buying mortgage bonds because of this cap. So this QT cap, first of all, QT didn't really start till June 15th instead of June 1st because that's when bonds were rolling off. And secondly, the cap at 47.5 billion per month, which is split 30 billion treasuries, roughly 17.5 billion mortgage-backed securities. If you think of prepayment rates in the mortgage market, prepayments are done usually because of refinancing or someone selling their home. At the very minimum, right? For every buyer, there's a seller. So people are selling their homes. Let's say prepayment rates come down from close to 30% to 10%. And, that implies roughly, 30 billion of mortgage-backed securities coming off or more per month. And so the Fed's cap is 17.5. The Fed might actually net be buying mortgage-backed securities, net of the amortization on its book. So until we see, 3 months from now, the cap go from 47.5 billion to 90 billion, right? There is excess liquidity, and you look at bank reserves, right? You look at reverse repos at 2 trillion. There's excess liquidity, right, in the market still, right, even after this collapse. And that the excess liquidity will take time to get sopped up. So I don't know using what data or what confidence the Fed can say QT is priced in. It's one of the sillier things I've read in the minutes, and it's been consistent across 3 Fed governors over the last 4 or 5 weeks.
Yeah. Andrew, do you want to take the next question, or?
Yeah, definitely. Thank you so much, Jay, for coming here and having a chat with you. Andrew is a macro guy. I'm more like a trader, a scalper. One question that a lot of our traders and a lot of our audience have is the trading in the institutions and the retail trading that we are having right now. I know you're off from institutional trading, but how is it different? Do you see the retail traders have any disadvantage toward the institutional traders, or that gap of knowledge and technology is gone? How do you see retail trading, especially in the last 2 years? It was a boom of retail trading.
Absolutely. So first on the boom in retail trading, since Robinhood forced other retail brokerages to go to zero fee trading in October of 2019, whether it was Schwab or TD Ameritrade, or even Fidelity, among others, we saw 400 billion of retail trading capital come into the market, 25 million accounts, and trading volume on the retail side went from 15 to 17% of the total daily trading to 35%. So we saw a sea change from 2019 to present day. And since then, we've seen option trading levels fall as the market has you know has turned over since really the taper announcement since November. The market peaked for a lot of speculative names in the first quarter of 2021, and there was a time where for unprofitable tech stocks, the option volume, the notional, was actually greater than the amount of stocks that were trading. So retail was expressing views on a levered basis, and we saw one of the biggest gamma squeezes of all time in Tesla, where retail traders they couldn't afford to buy the shares. They were just buying options and rolling them every week, and it was speculative fervor that I haven't seen since 2000. And when it comes to institutional versus retail trading, listen, they're good and bad decision makers at both. But I will say that the retail traders have gotten burned the most, apart from some of the big headline funds you've seen down 60%, right? Like the D1s of the world and the Tiger Globals of the world. There are, I would say most institutional traders who can mutual funds, right, are down, about probably around, 15 to 20%. And I was reading a B of A survey that retail day traders have lost, I think all of their pandemic gains, and I think there's a Goldman survey that was saying they lost more than half of pandemic gains. So they're calculating these things differently, but the tools that institutions have and the resources are often greater, right? So most equity funds right now have algorithms they run, so they can focus more of their time on research and less of their time on the actual trade, and they can manage their liquidity. And they have better access to management teams, right? Because through the sell side, research isn't that great at the sell side anymore. They're really there to facilitate meetings with management. And even though you can't get material non-public information from these calls, you can get a lot more information than you realize. You can call a management team and ask them, how do you think you're valued versus your competitor? How do you think you did last quarter? What were the mistakes you made versus this quarter? What's your outlook, and what parts of the outlook make you most confident? There are things that you can get out of management without them revealing actual numbers that you can't get out of just reading an earnings release or going through a press release or an earnings call. And I think that combined with real-time data, the fact that hedge funds can also pay for credit card data. They can also pay for satellites, right? If you want to track oil vessels coming out of Iran, right, and track the excess supply that is being traded out of the country, or if you want to track oil shipments coming out of Russia at this time, right? You can track everything using satellites and pay for a service to do that. You can even track, for retailers, how many cars are in the parking lots. Those are tools that that retail investors simply don't have. And another tool that institutions have is the GLG and expert network calls, right? So you can call experts, they're paid $300-400 an hour, former executives at companies, former consultants, former middle management at companies that will get on the phone, and there's obviously compliance rules. Sometimes you can't speak to them until a year or two after they've left the institution, but you can speak with these guys and ask them, tell me about your company. What were the barriers of entry? What was its key IP? What was good about the sales team? What was bad about the sales team? You can learn things that, individuals, investors have little hope in learning without being significantly out of pocket. And this is kind of just the tip of the iceberg. With private deals, you're getting access to deals that, individual investors normally wouldn't be able to get to. When it comes to IPOs, you'd be getting access to IPOs that individual investors may not be able to get access to. So, the institutional investors have that advantage, but they also have the advantage of experience or collective experience in that, I don't think that outside of, a handful of tech firms, institutional firms also don't their internal checks and balances when it comes to valuation and understanding businesses and cyclicality, where you don't buy the company that's over earning by 300% because of supply chain issues, because their earnings are temporarily higher, right? You can see through that. Or you don't buy the company trading at 60 times sales. You have some sort of internal mechanism or some sort of peer review or investment committee that prevents you from taking a huge risk. And please remember that there are hedge funds that blow up and there are hedge funds that take those types of risks. But most institutional capital, pensions, mutual funds, insurance companies, they have concentration limits, they have ratings limits, they have sector limits. That kind of prevents them from experiencing the same types of drawdowns that individual investors face.
Yeah, thank you so much for that. So not only there is still a technological gap, but as you mentioned, there is that knowledge, the collective knowledge, mentorship, experience, and definitely risk management still is in there. That's one of the goals that we're doing in our community, in our small trading firm, is that to give that mentorship to people to keep the money that they're making. Because as you said, in 2020, 2021, it was easy to make money, but most of those gains are gone because just the retail traders haven't used to risk management and protecting the profit. Adi, over to you for the next question.
Yeah, I kind of want to follow up on that, Jay. That was amazing. And I remember when I was an analyst and my portfolio manager, my PM, showed me how you can track the oil tankers on Bloomberg Terminal. I was blown away. But just on the topic of, since you mentioned kind of the Tiger Capital, is when you look at their fund and their basis is mostly focused on growth, right? So they're focused on high tech names. And when you got a rising rate environment, that whole thesis is not going to work out anymore. We saw that with Cathie Wood as well. Like, she was the second coming of Messiah. Everybody were making her so big there in the 2020 and 2021. But as soon as the rates started going up, that whole thesis of growth and long duration asset is completely out the window. So, what are your thoughts on these kind of one-sided firms of saying, or thematic firms where they only focus on, let's say, the FANG names or the growth, and when the macro changes?
So that's a great question. And, it's unfortunate that a lot of these sector-focused funds, they just simply don't have the ability, right? It's not within their mandate, right? I don't think Cathie Wood's investors would appreciate if you just pivoted to 100% energy today. So I do want to give some credit, because I think these guys have gotten really criticized. A lot of it is rightfully so. But now kind of focusing on the main issue, Cathie Wood and Tiger Global have both lost more money in the last 2 years than they've actually made investors in the last 10. That is the speed of the decline in terms of dollar volume. And why is that? Because their funds have grown, right? Especially over the last 5 years, their funds have grown. They've gotten more AUM. And so the average investor is actually down in both, which is very surprising. You would think, these firms have, multi-year track records, but, the sheer speed of the decline and the fact that it was at their peak AUM has really decimated the average investor in these funds. And I don't think the average investor is going to forget that. So I do think that, it will be difficult for, Tiger is Tiger. 40-year multiple, 40% multiple year returns. Yeah. It's not going to be erased. But what both these companies were doing was they were so big in that when they would put their capital behind a company, it would result in that company rallying just because they were involved. And there was a cycle where valuations in the tech sector were just completely overblown, and it started in the private market, right? In the venture capital market, over the last 15 years, VCs were just valuing companies on TAM and percentage share of TAM. And they're hoping that, one or two names in their portfolio would hit it really big and they could afford to lose on the others. And as long as some bigger growth equity company, paid more for the business than they paid for it, right? It was essentially like a really big Ponzi. And the Ponzi only blew up it really blew up with SoftBank, right? Masayoshi-san, through preferred and common equity, raised billions and billions of dollars to buy these companies, and he was competing with the Tiger Global of the world, right, and the D1s of the world, and was just offering, companies like WeWork, it's really just a subletting company, right? Insane valuations, right? And it was not sustainable and eventually had to break. And it would have broken whether rates had gone up or they hadn't. Rates just, the fact that long duration companies sold off and unprofitable tech sold off, it was accelerated, right? Um, by the spike in rates and tightening by banks all over the world, whether it's the ECB, Swiss National Bank, Bank of England, Bank of Canada, uh, the Central Bank of Australia, Banxico in Mexico, Federal Reserve, etc. Every central bank outside of the PBOC in China and Bank of Japan is tightening right now. And as the front end of the yield curve and the entire yield curve shifts up, right? If you value these companies with a DCF and you're valuing them on a free cash flow basis, what you're doing is you're taking the net present value of future cash flows and you're discounting that, and your denominator is R minus G, which is your discount rate minus your growth rate. And your discount rate, the components, right, are the risk-free rate and the beta. And the risk-free rate has been rising, and that's making your denominator bigger, and the valuations as a result are collapsing. So that's what people are using to justify this collapse. But I would say that the run-up in these companies during COVID was a bigger surprise than the sell-off. And it was bound to come down regardless, but I do think it's been accelerated. And these firms, I'm very surprised that they did not have big hedges. For example, in the Nasdaq, or very cheap hedges, because in November you could hedge your portfolio very cheaply.
Very cheaply.
And I'm surprised that they didn't. And with Kathy, one quick point is that if she had just kept the same portfolio from 2 years ago, she would have actually been 20%. Her fund would have been marked 20% higher. Her trading strategy of selling good companies for buying illiquid smaller companies, and increasing the risk in her fund has actually generated negative alpha. And I will say that some of the companies that Tiger Global has invested in, I won't even name them, are just absolutely ridiculous companies that don't generate any income or even some of them any gross profit. So I'm frankly very surprised that it got to where it did, from their investment decision making process. But this was inevitable, and this is why I focus more on value with the catalyst in special situations, because you can have more uncorrelated returns that are based on valuation, that are based on hard catalysts, where you can actually identify an up down or a risk versus reward that's more consistent over time.
Yeah. Andrew, before I pass it on to you, I got a follow-up question for Jay, because this is really interesting conversation. In regards to retail trading, and you were talking about how hedges were so cheap in November, and in our community we try to really have a institutional level training. So we talk about delta hedging, dynamic hedging to our traders, and one of the things is, of course, for example, Melvin blowing up. I mean, how did you not have, for a stock so heavily shorted, not kind of a ratio back spread that could kind of cover in a case of a gamma squeeze like that? Right? We teach this to our traders. How can they miss that? And my other question is, you talked about the Robinhood and the start of retail trading. What do you think overall in terms of retail trading for overall health of the market? Because I kind of believe that it's good that more retail is getting involved, and kind of bucketing the retail into the dumb money is kind of a mistake, because majority of retails are they're learning a lot of the things that are, and overall it makes it a more transparent market. We have kind of SEC looking after payment for order flow. Overall, what's your thinking on retail, the volume going from 10% to 25-30% in the peak of?
And Adi, I have to add that companies like Amazon, actually, they did the split so to be more attractive to retail. And that was their statement, that they don't want a $2,000 share. They'd rather to have $100, so retail would come into that.
Yeah.
Jay, go ahead. Sorry.
So you can actually buy fractional shares. So the idea of splitting, I guess it is attractive to some extent. And Tesla did it, obviously, and then Tesla was included in the S&P 500, and that was, one of the reasons why I think there's more trading activity in it. And then frankly, it also makes the options less expensive to buy, per contract, per 100 shares. But, I tend to focus more on the fundamentals. I think that, you know, the same drivers or the same reasons why stock rallied in 2020, 2021 might not work going forward, right? So you saw Amazon rally, 17% from the lows, and then a lot of that was, corrected after the split. And the same thing with Shopify, right? Shopify, it was funny when the Shopify CEO announced the split. A lot of retail traders were like, "Hey, didn't you already split? Because your stock went from 1,600 to 300, and now you're announcing the split." But I will say that, listen, I think individual investors are very important to the market. I was actually saddened by the fact that, algorithmic trading and, ETFs were such a big force in the market, and index trading has become, ETF industry, starting with SPY in 1993, is now, $7-8 trillion industry, and it's a large percentage of our equity market, right? So we need more in order for see more dispersion, more stock selection, because the hedge fund industry isn't really growing. You need retail investors and individual investors, and it's also good to have people educated. In fact, people should be educated in high school with basic concepts like saving, investing for the long term, how to use ETFs, how to find good companies to invest in for the long term. And unfortunately, it's not taught. And I think that individual investors should have more information accessible. It's actually my education is one of my focuses as well. At Special Sits Research, we provide models, and we're now coming out with courses to teach people how to model. We're coming out with frameworks to teach people the nuances of merger arbitrage and closed-end arbitrage and dual class arbitrage and how to trade spin-offs and split-offs and some of the more market neutral strategies along with hard catalyst strategies. And I think that by empowering yourself as an individual investor, you never have to rely on a financial advisor overcharging you and not really doing any research, right? Just asset gathering or investing in a high fee fund that, like 95% of funds underperform the market, right? By empowering yourself, to be very frank, if you're not in front of a computer all day, you should be, most of your investments probably should be passive, low fee type Vanguard type investments. But I do agree with you that, that individual investors should play a bigger role in the capital markets, because the capital markets are actually a tool, right, to raise capital. And everyone should be able to participate and vote with their dollars. Melvin Capital, to your other point, in January of 2021, Melvin Capital was a $12.5 billion fund. And it was founded in 2014 by Gabe Plotkin. And the speed, again, it's just astonishing. The speed of the decline can only be attributed to arrogance. And I say that because, to be short, and also not to cover your losses, right? After, the initial kind of meme rallies, right? They didn't just rally, 500-600% in a day, right? It happened over several days. And the fact that there was no covering, there was no risk management, if you were short, you didn't buy calls to, it didn't make any sense the way that this played out, and the fact that they got bailed out and then basically closed down because Gabe realized they would never reach their high watermark, so you'd never get an incentive fee. And exactly. I wouldn't be surprised if in another year he's going to start another fund. But to go from like 12.5 billion, to like 5 billion in less than a year, I think as of April 2022 is closer to 7. But it was just unbelievable how that played out. And I will say that there are other funds that are probably going to close down and liquidate, for various reasons. I think July is going to be a big redemption month, and you're not going to really see that, if it's not public until you start seeing some of the 13F filings after second quarter earnings, and you see some of the positions have fallen a lot in a lot of the hedge fund names. You've already started to see that, but I do think there are a number of hedge funds that are likely to close down this year.
Yeah, that watermark thing is such an interesting thing. A lot of people don't think, oh, he just closed down because he was kind of embarrassed. No, it's because of the watermark was so high, he can't really collect any more incentive fees. So it's out of selfish reason again. and that's very interesting.
Yeah. So hedge funds have a 2 and 20 structure, and, fees have come down a little bit. So let's say today it's more like 1.5, 15. What does that mean? That means like you're charged a base fee, right? For them that pays for their employee salaries, back office, risk management, compliance. It's really, it pays for the infrastructure of the fund. And then the incentive fee is like a profit share. So if, the fund is up, 100 million, the fund usually is entitled to 15 to 20% of that P&L, right? So that's how these guys are paid. That's why they're in the industry, right? That's why they're not mutual funds, and that's why they attract talent. But, I think, one thing that people don't realize is that if the fund, has a loss, until it gets you back to where it was prior to the last incentive fee, they don't earn any incentive fee. So if the fund went from 12.5 billion to 7.5 billion and gave thought that I'm never going to make this money back. It's going to take me 5 years to make this money back for my investors, right? He wasn't incentivized, so he shut down the fund. And investors were furious about that because they're like, "Hey, you lost this money, make it back." And he just chose to liquidate on May 18th.
That was insane. Andrew, do you want to
Jay, what's your thought on the housing markets? I know that there was a huge growth in the last year or so, over 30-40% on some areas. But looking at some leading indicators like HMI, the lumber futures, and overall price to rent ratio, do you think there is any systematic risk into housing market right now?
I wouldn't frame it as systematic risk. I do think I actually have written, on my team, we have a handful of analysts, we've written 2 notes. We've written about the Canadian housing market, which I think is very weak and could see a 25% decline over 12 months. And we written about the US market, which is a little bit different because every geography, for example, the Sun Belt is seeing population growth, right? While areas like Chicago and the West Coast, in some parts of the Northeast and the Great Lakes areas like Detroit, you're seeing population flight. So the dynamics are a little bit different than Canada, and there's less, foreign investors. But I will say that while the real estate prices weren't rising, in the parabolic fashion as they were in Canada, we saw prices up, roughly 23%, depending on what source you use. Realtor.com, for example, the average listing is up 23%. Year over year, and if you go through the, Case-Shiller data, and you actually figure out, how big the residential real estate market is, you can calculate that there's $7.5 trillion of wealth created in the real estate market, and for the average citizen of the United States, it was their biggest source of wealth creation. It wasn't the stock market, right? Only 33% of investors had 401k. Whereas 60+% of families have some ownership in property. So I think the Fed realizes how quickly today. If you listen to the Waller speech, Waller literally said the Fed is not actively trying to crash the commodity, the equity, or the real estate market. But then he quickly said, but the real estate market speed of price appreciation has been, I think he literally said, crazy over the last 2 years. And if you read the Federal Reserve minutes from December, I think that even then the Fed was talking about the inflated multiple inflated P multiple of the equity market, and they were talking about even potentially selling mortgage-backed securities, which I don't think they're going to do in the near term, but selling mortgage-backed securities to slow down the speculation in the real estate market. And mortgage rates have done that, right? Mortgage rates were 6.2%. They've come down to 5.3%, but it's still pretty expensive. It's 60% more expensive when you calculate the change in price of homes along with the mortgage interest and calculating the mortgage, your monthly mortgage, 60% more expensive, right? So if you were buying a home and paying, a $3,000 mortgage, right? You're now paying $5,000 for the same mortgage 2 years, 2 years from now, from then. So it's prohibitively expensive for the average American to now buy a home, right? So I do think that you're already seeing, even in hot areas like Texas, suburbs, you're seeing you're seeing listings marked down by 5%. In Canada, I'm seeing listings in Surrey. I'm seeing listings in suburbs of Toronto that are being marked down by 40%. That is how heated the market got. So I don't think it's, it would take a rocket scientist to estimate, prices could be down 10% over the next couple of years in the US or more. But, one important thing to realize is, like, after 2008, after Lehman collapsed in September, it wasn't until 2012 that across 20 metropolitan cities, across all of them, that real estate bottomed. So it literally took 3 years after. It's not as quick as the market, right? It doesn't price things. The market is forward-looking, 6 to 12 months ahead, depending on the sector, oftentimes. But the real estate market, right? There's a bid-ask spread, and you need transactions, right, to happen. And if you locked in a mortgage at 2.5%, you're never selling that home, because if you sell it, you can't buy something else at the same size. So there's more illiquidity, and I think it'll take a longer amount of time. But I also think that there is the government, kept this from really correcting because of the foreclosure moratorium and the eviction moratorium. So you have upwards of 7 million tenants that benefited from this eviction moratorium, and I will say that foreclosures and evictions will probably rise this year. It's state by state, so there's some states that are allowing it, some that are not. There are people that got away with not paying rents, even while having a job, right? And they took advantage of the system. And on the flip side, on the demand side, there are a lot of people that committed fraud and took PPP loans, right? They took money and they never hired people for the business that they were planning to hire from. They're wealthy people that, for tax reasons, own many holding companies, and they use those holding companies to get PPP loans. They never paid them back. And I think a lot of those people will be discovered, and some of them will be prosecuted, and then a couple of them, including a very popular FinTwit guru, has gone to jail for doing that. But I do think that a lot of this was demand driven. Some of it was supply driven, given that there's 600,000 homes per day of underbuilt since the financial crisis, and millennials were living with their parents. They're living in cities. They had saved up money, and until COVID, many of them hadn't pulled the trigger to buy a property. So there are many, many reasons that contributed to the increase. But I will say that it is very likely that we see a slowdown, and you might even see a decline in employment in the housing and housing-related sector. Because home builders and contractors, right, they make fortunes, right? I have a friend who lives next to a roofer, and this roofer drives a Maserati. He's like, how does this guy drive a Maserati? It's because he raised his price from $15,000 a roof to $50,000 a roof. And it was well above the cost of materials, and he could do it because there's demand. And the whole sector, you look at the home builder ETF, XHB, and like a number of the names like DHI, Lennar, Hovnanian, Toll, like they're all down like 40%, right? Because the market's kind of forward looking and is assuming that their margins will come down.
In many cases, by the way, they're trading below their book value, which is basically market anticipating markdowns, inventory markdowns in the future, which that was surprising to me as well.
Yeah, and some of them actually are starting to look cheap, but again, until you realize that this could last 2 or 3 years, if this were like a 1 year type quick decline, and the home builders were cheap on a 2 year forward on a normalized using a normalized framework, and assume rates come back down as the economy slows down, right, to more of a neutral rate. So let's say the Fed continues to raise rates and we get to 3%, and then cuts back down to 2 next year, and mortgage rates normalize kind of at a 4 handle, right? Some of these home builders may not be very expensive today, but if you really think about it, if this housing correction lasts 2 to 3 years, there's no way anyone can forecast what gross margins are. And I think if you look at sell-side estimates, a lot of these companies look very cheap because the sell-side estimates, they haven't come down yet. And it's funny because a lot of investors, especially individual investors that have access to tools where they can get Wall Street estimates, they often use those estimates and say, wow, this company's looking really cheap. It's trading at 4 times forward, 5 times forward, but you don't realize those earnings could be down 50%. So it's really trading at 8 to 10 times forward. And I think, there needs to be more discussion so that people understand how to think about these things.
We have a saying in our community. We say when you look at sell side research, just know it's a lagging indicator. You want to look at leading stuff. I kind of want to take it a little back to trading. It's an awesome conversation, by the way. We have over 280 people tuning in right now, so thank you. Looking back, of course, in hindsight, it seemed like the best trade for the first half of 2022 was short, high beta, long, low beta. I know you're mostly look at SPAC arbitrage and merger arbitrage, but what are some of the areas you think in the second half of 2022 could be really profitable in terms of trading? What are some of the areas that you're looking at, of course, without giving away so much of your secret sauce?
Yeah, so I do think that there's a lot of cash on the sidelines. For example, in U.S. private equity, there's $1.8 trillion of cash on the sidelines. And with global private equity, corporate cash as a percentage of enterprise value at all-time highs, one could say that strategics and private equity firms have $7 trillion of dry powder. So I do think there's going to be increased M&A once the bond market opens up again, and that's one of the reasons why we aren't seeing a deal every single day. And we're seeing maybe a deal a week or a deal every 2 weeks because the bond market is shut down. But once the bond market opens again, I think you're going to see a flurry of deals. And I do think in the merger arbitrage space, there have been a number of opportunities that were liquid with big companies, whether it's Citrix and Elliott or Tenneco today, which was up 11%, right? For something that was trading with a floor price, given that Apollo was buying its bonds, had given a firm cash offer. There are opportunities where you can find, or Sanderson Farms, right, an agricultural company that we were able to figure out had a 203 offer, but we could buy it at 180, and it actually traded through the offer because it was so cheap to peers and didn't have debt. I think the merger arbitrage space will continue to be fruitful. On the SPAC arb side, there are three types of shorts that have done extremely well over the last 2 years. And, we really went viral, because we pointed out that, SPACs follow merger law. They don't follow securities law. They were giving these 5-year incredibly optimistic forecasts. The sponsor is getting a 20% incentive fee through warrants or more. So, and the underwriter was getting paid in warrants and stocks. So all these guys were incentivized in the wrong ways. And, that resulted in, in 2021, only 32% of these companies beat or met their revenue earnings estimates versus 80% at the S&P 500 level. So being able to short these in 3 different ways, created a huge alpha opportunity in 2021 that I think everyone was able, that had information or access to SEC filings could have benefited from, because it was all based on public information. And one was, the X redemption trade is when a SPAC loses its floor. So to give you a perspective, a SPAC is an instrument that can invest in, really 6-month treasuries or money market securities. It's a box of cash. And the idea is the management of that SPAC is going to find an attractive target to merge with. And these SPACs, some of them focus on sectors, whether it's electric vehicles or renewables or fintech or online gambling or biotech. Some of them focus on geography, some of them focus on trends. But all in all, they tend to buy companies. And the biggest buyer of SPACs is individual investors, right? So they're buying companies from institutional investors, VCs and private equity firms, at above market multiples and basically throwing them at retail. And you go from the SPAC IPO, where you do have an institutional investor sometimes participating, you get a free warrant, you can sell that for 3-4%, and then you're left with a box of cash trading at a discount that you can essentially arbitrage for its discount to NAV and make a few percent. But in reality, how we have been generating alpha is after the definitive agreement, after the second stage of the SPAC, after they announce a deal and there's a vote, you can actually estimate, what the quality of that company is, what its ability is to generate free cash flow. You can look at the quality of the management, the underwriter, the sponsor, the sector, whether it has barriers of entry, and make an educated guess, especially if it has options on, once the floor is removed on the X redemption date, where could that SPAC reprice? And that's been a really interesting way to generate alpha because of the increase in implied volatility and the moves in delta. And the second, the bigger opportunity has been, all these SPACs have pipes. They're essentially private investments in public equity. They're done at, sometimes 15, 20% discounts to the net asset value. And these hedge funds get in, they think they're making a risk-free profit, but in reality, since the tech market rolled over in 2021, the average SPAC trades down, almost 50%, right, over 6 months. So these hedge funds are now scrambling because they thought they're making 15% risk-free to sell these, and they're locked up until the 424B3 filing or the S1 goes effective. So what we're able to do is, because we're not a hedge fund, we don't have any positions here, is we're able to look at, shorting these or buying puts on some of these names ahead of the pipe unlock. And it's a very interesting dynamic because now that SPACs are out of favor, you're seeing higher redemptions. The average redemption has been over 85% for the last 20 deals. And what that does is it leaves a very small float. And usually the pipe is around the same size. It's smaller now, but historically it was about the same size as the float. So if you have a $100 million pipe and a $100 million float, and there, let's say 95% redemptions at the public entity and cash and trust, right? These SPACs, the reason why they work as trading vehicles is you can request 3 days before the vote to get your cash back. So that's why there's a floor. And after that floor goes away, that once that cash leaves the trust, you're left with a micro float. So let's say there's a 95% redemption, you're left with the 5% float. And let's say there's a pipe also of 100 million that's funding the deal. Your pipe to float ratio is now 1 to 20, right? It's a 2,000% pipe to float ratio. There's $20 of pipe, there's $100 million in the pipe, and there's only $5 million left in the trust.
Yeah.
Right? And that trust is being used to fund the deal, and the pipe is being used to fund the deal. When the pipe goes effective, and those shares are unlocked and hedge funds scramble to sell, it becomes a massacre. And that's why, the pipe unlocks have been such a good trade. More than 8 out of 10 of them have hit on the negative side. And you have to be careful and avoid certain types of situations. And then finally, 6 months after that, right, you have a 180-day unlock where these VCs have been tearing up and watching these hedge funds, sell shares and push the value of their equity lower. These VCs, the old sponsors and management teams are allowed to sell. Usually 6 months or 180 days or at a certain price. If they're above, 20, if they're above 20, 18, 15, 12, for more than 20 trading days, sometimes they're allowed to sell as well. But usually it's after 180 days. And we've tracked the last 140. Pipe unlocks, we've tracked the last 120, 180-day unlocks. And those are great ways to generate alpha as well. In fact, in the middle of June, there are a number of these that sold off, 30, 40% in 2 days. And it coincided with Russell rebalancing. But it is a very interesting market. When you're looking at the broad market, like S&P and Russell, I will say that there has been more of a bid for growth as rates have started to come in. Rates have started to come in because there's the idea that we could be entering a global recession, especially Europe, given their cost of fuel and energy has gone up like 500%. You think about like Germany exports cars and heavy machinery. Big input costs for their factories is electricity, and electricity, right, is generated through coal, natural gas, wind, etc. And if you look at the pipelines coming in from Russia, Russia supplies 40% of natural gas to Italy, 30% to Germany. It's really a tough situation where they generate most of their heating fuel and their electricity from their biggest enemy. And after this Ukraine, the war that's been declared, Europe could be in a stagflationary environment, or most of Europe's actually probably already in a recession, and that's resulting in the euro hitting almost parity for the first time in 20 years. Which is negative for the rest of the economy, right? Because Europeans buy a lot from Asia, right? And with a weak euro, they're going to be buying less. They're probably going to be buying less, and the less Europeans are going to be coming to the U.S., right, for tourism. So it's going to slow down. It's a shock to the economy. It's going to slow down the global economy. At the same time, the Swiss National Bank is selling equities, right, to try to shore up their currency.
Yeah.
And I do think that we are at a point where, one of my personal trades has been shorting the euro. I've been shorting home builders and shorting unprofitable tech. Companies like, Carvana that generate $800 of gross profit margin per unit just by financing, and the financing markets aren't there, right? With higher interest rates and a consumer debt rising, it's going to be harder and high car prices that are now coming down. It's harder for people to buy cars, and most of Carvana's locations weren't profitable. If you read the public filings, like none of this is conjecture; it's all just based on public filings. Same thing goes for the BNPL sector. You saw Klarna was just written down by 95% its valuation, right? SoftBank got completely destroyed in the new valuation that came out for a private company, Klarna, and its public competitors Affirm, right? You look at names like Upstart with higher delinquencies, right? There've been a lot of like layup trades, and even like low volatility trades like puts on Apple over the last 3 months have just been huge winners because you saw handset demand down 40% in China.
Jared, thank you for sharing some of these personal trades. I really appreciate that. What about the crypto markets? What's your thought on the crypto? Are you short or you're long bias? And overall, what was your point about this whole crypto mania in 2021? Was it because of the cheap money? The people start dumping money on tokens named after dog or JPEG of monkeys? What's your thought? Would you put any money over there?
I am not a big proponent of crypto. I have, some hedges on, and I follow the market closely, but it's not very easy to short outside of the public names like MicroStrategy, Mara, Riot, Coors. Yeah. Those names have just been destroyed. As Bitcoin has gone from 60,000 to 20,000, and I think it's very naive that people don't realize that the same reason crypto went up, or the same reason people thought crypto went up, right? The increase in M2, if the Fed, right, is going through with quantitative tightening, right, shouldn't the opposite effect happen? I think with crypto, the people I've met online over the last couple of years, like they will never admit one negative attribute. There are 19,000 cryptocurrencies. Most are going to go to zero. I say that with almost 100% certainty. That out of the 19,000,
about 15,000 coins that they call them shit coins. That's a lot of them definitely going to go to zero. Yeah. Jay, I have to personally drop off because I have another meeting. Thank you so much for that. For those of you, I know there are 250 people right now. Follow Jay on Twitter, Special Seats News, which is essentially a special situation research newsletter. I learn a lot. I learned a ton. Definitely subscribe to your newsletter. And I just wanted to thank you. Adi is here to finish the conversation, but gives a thumbs up to Jay for his time, generous time, and sharing all of this information. And thank you so much. And again, it was an honor and a pleasure talking to you. I have to drop off. Again, thank you so much.
Well, thank you for having me. I appreciate your time.
Yeah. Yeah, definitely. Jay, it's so interesting when you were talking about the pipe, and one of the better successful trades that we did for our firm was shorting Mile, right? And Mile was one of those SPACs, and of course the pipe agreement came in, and you could just see the massive amount of dumping that company was taking. And again, those opportunities were there. You mentioned online betting, and I remember really, really vividly because I was researching DraftKings. And I was looking at their, I was looking
$2 billion, right?
I was looking at
evaluation.
Exactly. So I was looking at their filing, and they had United Kingdom as an example of this is a mature market, and if we can get legalized betting in every state, it will be similar to United Kingdom. I don't know if it was United Kingdom or Australia, but the total TAM was 70 billion. And when they were trading at $68, their market cap was 70 billion. So it was so insane to me looking at this, but at the same time, like I couldn't pull the trigger and short it because you don't know how irrational the market is going to be. How do you see Like, what is the signal that tells you, okay, now this bubble is about to burst, and I can confidently short these SPACs, versus, you know, someone like me looking at this and I'm like, I don't want to pull the trigger, even though I know this is a structural bubble. I don't want to pull the trigger because I'm not sure what's going to happen.
Well, I think it's an art and a science. A lot of it's sizing, right? So if you use put options, you know what you can lose. But also, what really clicked in my mind was after October, I think the market had already had a high level of confidence that the Fed was going to taper. And that taper was my first, it was literally the Fed calling and shaking you by the shoulders saying, hey guys, we are going to be taking liquidity out of the market, right? Yeah. And in the minutes we're saying like the equity market is expensive, right? Inflation was high single digits. I viewed it as a no-brainer, right? Like obviously these things were very difficult to short from 2020 to 2021, but by October of 2021, if you weren't short, you weren't paying attention. Exactly. And you know the way to play it was to find the companies that were the most broken, where they're going to have to issue equity. You know, the companies that weren't generating free cash flow, right? Like the LTM EBITDA for DraftKings is like negative 1.6 billion, and even for 2022, they're going to burn like free cash flow. They're probably going to burn, according to sell side. It's not my estimate. It's a sell side estimate of 900 million, right? And they're still going to burn $500 million in 2023, according to their own guidance and sell side estimates. So it could frankly be worse than that, right? In a recession where people are betting less, but who knows? Companies like that, even if they have $1 billion of cash on the balance sheet, that cash is going to fly away and they're going to have to raise equity. So those are the companies that I focused on. And then on the long side, you know, I've been focusing on companies, you know, where there have been themes, right? Like CVS, right? During COVID, people going into the CVS store, increasing sales. There's an easy theme, and then they announced a $10 billion buyback because it generated so much free cash flow. You know, Zim, when container ship rates were going up, it was a home run because I saw they were going to do like $5 billion of free cash flow. That was more than the market cap, right? And then they paid a $20 dividend and sold out of it right then and there. There are names, you know, for example, early on in the pandemic when energy was, you know, oil prices went negative, we were hand over fist buying energy. We're buying refiners, we're buying upstream, we're buying servicers, we're buying midstream. And today, right, I do think if you want, you know, to participate in the market, there are preferred stocks that are yielding, you know, 13, 15%, whether it's in, you know, financial sector, mortgage sector, MLP sector, or in the BDC sector. A lot of these preferreds trade senior to equity, and they pay a fixed coupon or a dividend of 6-7%. You can buy them at discounts of 20%. So your current yield, you know, is high single digits, sometimes 8-9%. But if you were to go back to that 25 par on the pref, you know, you're making a double-digit total return, which is attractive. And one of the trades that has done well for us is buying, you know, closed-end muni fund at, you know, 15% discounts to NAV for states that have good finances. Other things that we've been doing, you know, buying, you know, good utility companies, companies with durable recurring free cash flows. And we've even been putting together a list of high-quality tech names that we would be interested in, you know, as their valuations have come in by 40-50%. You know, if we get closer to a Fed pivot, then some of those companies will do incredibly well. And finally, there's been several areas. Well, another area is buying, you know, energy pipeline companies. They're called MLPs through funds at big discounts to NAV, because a lot of these companies have interstate and intrastate pipelines that they generate tariffs from, and they're not correlated as much to actual commodity prices. So there's always a lot to do in the market. I like to say, one of my mentors taught me, there's always a way to make money in the market. You just have to do the work.
Yeah, exactly. Definitely. I mean, one of the things I tell the community during my time is the relative trade is really coming back. So like, you know, GBTC, like trading at like 30% discount, you can go long GBTC and short Bitcoin and really eat off that spread. Like, I feel like macro and really looking at the bigger picture is playing a bigger role every day in the market, especially after 2008. I think before that everyone was like bottom up, and now everyone's like want to look at the bigger picture and what's going on in the bigger picture. Jay,
I do think that the bottoms
go ahead, please.
The bottoms up analysis, you know, that's how most institutional guys are trained, right? Look at a company, you know, look at Porter's 5 forces. Does the company have pricing power? look at the company's moats, look at its competitive landscape. What are the unit economics? Is this, what is the management team like? Do they have good track record? What is capital allocation policy like? How has the business been compounding? Have margins been growing, declining? This is the kind of bottoms up work that you're trained to do as an investor. But I think what a lot of investors have learned is, being cognizant of factor exposures, being cognizant of the value drivers, what's driving top line, is a lot of that is sector driven. So it's more macro. And the Fed, unfortunately, since 2009, since Bernanke started QE1, QE2 operation towards QE3, the Fed effectively has become the market. So if you're not focused on the Fed and you're just focused on the bottoms up, sometimes you'll underperform the market for years. So be cognizant of your factor exposures, sector risks, value drivers, and the Fed are important now for every type of investment, because it's not safe to just blindly buy and hold. There have been very well-known investors that have lagged the market because they've avoided looking at that. So, I do think that macro is more important in bear markets than bull markets, but I do think having some basic understanding of it is important at all times.
Yeah, I'm having one of my best years, and it's because I'm mostly kind of a macro focused trader. So it's been good. But it's interesting that you say Fed is the market. Yeah, a lot of people made a lot of money from 2010 to 2020, thinking they're geniuses. But it was just rates were the risk-free rate was so cheap you could make money. Yeah.
There's a bid from the Fed. They called it the Fed put. Every time the market was down 10%, there would be some market commentator or some talking head on CNBC. Oh, the Fed's going to come in. Don't worry. Kramer would come in, but the Fed put isn't there, right? It could be there, but it could be another 20% lower from here. No one knows, right? And in fact, in 2018, the Fed pivoted not because of equity markets primarily, but because the credit market was completely shut down.
Yeah.
And we might be at that point over the next several months where the credit market's just shut down. And the Fed doesn't want companies to go bankrupt because, companies going bankrupt means higher unemployment.
Yeah.
And, I do think that the Fed is more comfortable with credit spreads being higher than they were in 2018 because they actually want unemployment to tick up and they want the 11 million jobs. There's 1.8 jobs for every person right now. They want that to come down to the average, which is around 1 before unemployment starts going up more meaningfully. But I think they can afford a couple of bankruptcies, and they can afford unemployment going to 5% before they start getting worried. So there's more wiggle room there.
Yeah, definitely. We're right at the hour mark. So I just want to ask the last question. Of course, thank you so much for being on the show, and it's been an awesome conversation. I definitely got a lot of value out of it. Of course, us being a kind of a retail trading community, we try to bring institutional background, but still, as someone who has worked at the big desk, right? Like you've kind of seen the different market cycles. What's kind of your advice for retails and our community members? What do you think they should do? What can they do to survive this market and actually prolong, right? Like longevity. It's not about how much you made; it's about how much you keep.
So of course, capital preservation is key. And again, nothing here, and I know you guys disclose this, nothing is financial advice, but I personally say that I do have a higher cash balance than I had, right? Waiting for opportunities. You don't need to be fully invested at all times. In raising cash, I think in the middle of last year was probably the smartest thing I did. You don't have to go short. You don't have to spend all your time thinking about the market and doing analysis. Simply raising cash last year, put you far ahead of everyone else in the market and being in lower beta names and rotating from some of the long duration names to some of the value names. I will say that having that, if you read Seth Klarman's book Margin of Safety, it allows you to actually take more risk when people are fearful and there's capitulation. So I think having cash, actually knowing what you own, know the companies that you own, know what's driving them. A lot of people were burned, buying pandemic beneficiaries. Right? If a company did really well because everyone is at home, well, guess what? Everyone's not sitting at home anymore. So the video game companies, the Pelotons of the world, that was supposed to be the next Apple, right? The Zooms of the world, they're not going to be you're not going to see the same multiple and the same level of growth. And the third thing is, to manage your risk, and you can manage your risk in multiple ways. It can be through diversification. And look, you can buy CDs today, certificates of a deposit, at almost 3% at certain banks, right? You can earn interest. You can never earn interest over the last few years. So there are other places to put your cash. There are smart ways, right, that you can generate alpha through arbitrage with SPAC arb, merger arb, dual class arb. Open your mind, right? Look at closed-end funds. They're actually less risky than buying penny stocks and OTCs and crypto and the types of things that people have been doing to generate alpha. Look at municipal bonds, right? These are local government bonds, right? You don't have to pay taxes on them, right? You can actually generate a spread over treasuries. And if you're comfortable with shorting, if your portfolio is mostly long and you don't want to raise cash for tax purposes, find a way to hedge your portfolio, or at the very least generate a synthetic dividend by selling covered calls on your portfolio, or lower the price of entry by selling cash covered puts without leverage. So I do think that there are a lot of tools that individual investors have, even using retail brokers, and they just need to be more flexible in the way that they think. So I think knowing what you own, having a margin of safety, being flexible in the securities you have, finding other places to park your cash where you can generate yield and wait this out, not levering up and buying, and flipping properties in this type of environment. Like, those are all such basic things that I think people can do, generating synthetic income through covered calls, so that they don't see big losses, and generate incremental income along the way. And obviously that strategy will change once the Fed pivots, but for now, that is what I've been doing.
That's exactly right. We've been preaching. I mean, we're mostly focused on kind of intraday, but since I joined and adding a little bit of a macro elements, adding options, I always say it's about different tools in a toolbox. Looking at opportunities, really brighten your horizon. And that's definitely right. And like last year, we were all long TQQ and these levered product. This is not an area. This is not an environment for leverage now, right? When Fed pivot, which by the way, the yield curve is telling you the Fed's going to pivot. If they did pivot, we're going to go back on leverage, right? We'll do the Fed trade. But Jay, go ahead.
The pivot could be next year, and also just so your viewers know, these products are broken products, right? The levered ETFs, they're not meant for long term. Traders will use them day to day, but if you look at the decay on some of these products, like look at oil, for example, like it's a natural gas levered product. Look at it over like a 10-year, and you'll see that the product is completely broken, and people lose fortunes trading these levered products, right? You look at this product over the last 10 years, it's traded from 40,000 to 50. Tell me that product is safe to trade. Whereas natural gas is actually higher than it was in 2012 when this product came out.
Yeah, that's how the math works against you, right? With leverage, right? And a lot of people don't understand these drawdowns, and then this resetting on a daily basis is going to really set you behind. Jay, it was phenomenal speaking with you. Thank you so much for agreeing to come on the show. We had at some point we had over 300 people tuning in. Of course, we'll put it on our YouTube channel as well for rewatch. But thank you. It was an awesome conversation. I definitely learned a lot. I'm sure our community also got a lot of value out of it. Thanks again, and definitely I'll put a link in the chat so people can follow you on Twitter. Tons of useful information.
Well, have a blessed day. Thank you for your time. I appreciate sharing thoughts, and looking forward to the next one.
Absolutely, and if you're in Vancouver, come by and see us in our office. We would love to host you.
Yeah,
thanks
happy
again.
to come by.
Cheers. Thank you, Jay. All right, so with that was our conversation. Man, what a great conversation with Jay Singh. Again, he worked at a merger arbitrage desk on Goldman, and this is one of the things in merger arbitrage that we talk about in the chat room. I've talked about going long kind of the target, shorting the acquirer, but they were also looking at, they were working kind of with a legal team. And this is that informational edge that institutions have, working with a legal team to know what deals are not going to go through and shorting the target after the news comes out. So, using that information, I thought it would be a great day kind of to bring him on, give that institutional level perspective as well for our viewers. Thank you so much for tuning in. Definitely give us a thumbs up, like the show. I work really hard personally to bring quality guests, and the more popular this show gets, the more better and better guests that I can, high caliber guests that I can bring. My goal is within the next few years bring Cathy Wood and grill her a little bit on her funds, but that would be awesome. But with that being said, that's Thursday, end of our Closing Bell show. Thank you so much for tuning in. We will see you next week on Tuesday. Next week we have Brian Shannon as a guest on the show, and we also have another trader coming in on Wednesday sharing his story and how he became consistent. His results are phenomenal, and I can't wait to share his result with you as well. Thank you so much, and we will see you next week.